Welcome to Fill or Kill. We're brand new here. Brand new lighting, brand new mics. There. We have an Ed that's like fully rested. I think he went to the amusement park yesterday. And we have a big topic today. We are talking, well, what are we talking in?
Well, a couple of things. There's a couple of big stories. Well, one big story about George Soros sprung in the last 24 hours. I was out effectively. It's good to step out. Um, as Jesse Livermore said, you can't trade the markets all the time. You're just not, emotionally, you're just not strong enough to do that. It's good to take a break. But one thing I did notice, because it's quite important to some of the positions I've got, and people will know, some will know why I listen to George Soros quite closely. There's a big story about George Soros, who is allegedly short a chunk of S&Ps and allegedly sold. I think he doubled up was the comment, and so that begs lots of questions about: is he really? Or why are people doing this? The Wall Street Journal yet again is publishing a bearish story. It's a question really comes down to what does this mean? And too often, too many people are biased in their approach to not even trading, but to reporting markets. They have an agenda for whatever reason, and the question is how does one, as a trader, see through all that
Yeah,
and get rid of not other get rid of two types of bias really.
yeah,
One is other people's bias, so you can make informed decisions, but the other one is your own biases. So again, you can make informed, neutral decisions about what the market is telling you, so you can employ and put into practice an effective trading strategy rather than one that rests too much on your emotions and what you want to see rather than what is happening.
yeah,
So that's kind of where I wanted to go down to. We talked about last time about correlation, which begged the question of causation. George Soros has spent a lot of time and effort talking about causation, about the nature of markets, which is fascinating in itself. So that's kind of, I thought that it all kind of hung together
yeah.
because we've been talking about, the Wall Street Journal, CNBC story about 1929, and now they sprung George on us. So I wanted to find out and talk about what was the real story.
Yeah, and I think it's a great. I mean, when I woke up, at least 10 different ways, this George Soros story jumped at me. And what I think is so fascinating about this story is because I've been on that side of the fence before. I have. I've been a guy who's reporting stuff like this and hyping up a bearish story, and you know exactly how well that sells. If you're so we had a MarketWatch article of this up, one of the first ones I saw, and which is owned by the Wall Street Journal, and they're going through George Soros's 13F, which is his filing for his fund. So first of all, these 13F stories are almost entirely useless. In some cases, it can be useful if you're talking someone like if you're talking someone like I don't know, Ackman or someone like that. A 13F might be useful, but for a guy like Soros who can flip a position 20 times in a day or have a very complicated position, knowing what he did 90 days ago is not exactly valuable information. I don't know how you view information, but
Well, from George Soros's point of view, the guy's a very clever man. He has a concept which he likes to pursue. You take going back to 1992, famously when Britain was forced to leave the ERM, being tied to the ECU, and the whole basket. He was short about close to well, I won't go into the numbers, but he was not short. Amazingly, he was aggressively short, but he was not even as short as he wanted to be. And what was funny was Norman Lamont came out and said, "We've arranged a facility to defend sterling to the tune of 15 billion." And that's exactly was
yeah,
the amount that George Soros was looking to sell ultimately. And the numbers that he was reportedly sold and didn't sold and would have sold is all being, it's all apocryphal. Um, if you're restricted to trading one outlet, and that outlet is publicized, then bang to rights. That's your position.
Yeah.
But if you've got many, many ways of trading a market and do, I mean, I'm a small guy, but I trade the market in several different accounts and different ways as to how I want to do it, etc.
Exactly.
Timing, blah 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 blah.
And hedging, I mean, basic hedging.
Yeah,
Who
hedging
knows what this
strategies.
position is?
You know, I think it's a question to what extent you can do that in several places in the world. We're pretty flexible here, but you know, again, it gives you more outlets. It's difficult. You've got to be really careful. I'm always surprised by the way certain media go after certain individuals as to what their positions they're carrying or not, because you just don't know. If it comes from the horse's mouth, if George Soros comes out and says, I'm short 1.4 billion S&Ps, you got to ask yourself, well, why would he say that? Or why would he be lying about that? But from what I can tell, he hasn't. But let's say, But why is that important? Why have we spent 5 minutes already talking about whether George Soros is short or not? The simple reasons for it is he's got an uncanny knack of picking significant tops and bottoms. Some, I think it was, I've forgotten the name now. Was it Ackerman? Would claim that one reason is that he actually creates the tops and bottoms himself, because the market's looking toppish. Suddenly here, take 15 billion, yours. How are you left? No bids. That's how he
I've never
can
heard that
create
theory.
tops
That's a
and
great
bottoms.
theory, by the way.
Sorry.
That's a great theory.
Well, that is self-fulfilling.
Yeah.
Yeah. But again, I'm just. Wall Street Journal covers a 1929 story just as the market's ramping again. They've covered it again.
Yeah.
Just as the market goes up a bit more, suddenly George Soros is doubling up. I mean, is the editor? Does the editor want to declare an interest in this one? I don't understand. I don't know where they're coming from.
It's basic journalism. A negative story always sells more than a positive story.
Yeah, get in your face, you mean?
No,
And
I
then it
mean,
begs
like
the
the Wall
question
Street
to
Journal
what-
guys, they don't trade. They have no incentive. Their incentive is to get clicks, sell ads. Like they sell a penny ad or something if you click on it, and they know George Soros shorting is a much better story than George Soros betting on something, like a positive.
Yeah, I mean, everyone. There's several forms of biases in the market. One is there's a media bias, Fox News. Hello. But there's all sorts of biases. In fact, I found a really useful list of about 10 biases. Actually, do you want to put that up?
Yes.
You see, it's 10 most common behavioral biases. That there's a lot of things about bias that apply generally in life, but actually really apply really well in trading. And there's one, number 8 on the list. Is it number 8 on the list? We prefer stories to analysis.
Yes.
Yeah, that's a classic. Oh, George Soros just sold a yard. How you left? Well, my chart says it's going higher, but George Soros just sold it. Yeah, and it's interesting. And you then spend 20 minutes pursuing the story, trying to see if it's real, and you end up you actually don't know the outcome, and if you knew, would it affect your analysis and what you do, and should it, etc., etc. So sometimes you need to discount all of that. But the reason why George Soros, what he does, is interesting, because there's a couple of reasons why. Because he's really interested in bubbles, which we've talked a bit about. If you want to put up, there's a second quote there, I think.
From
About
Soros?
George Soros saying...
We have a million Soros quotes here. I'm sorry. 1 second. Yeah.
This is the guy who...
I have a record
fought.
of Crying Wolf. Is that the one?
No, it's stock market bubbles don't grow out of thin air. No, it's not even Galbraith. Let me read it out then. Stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality as distorted by a misconception.
Yeah.
Yeah, and why is it distorted? And it's because the information flows are distorted. It's what sells newspapers and what gets to people and primarily what they want to hear. Which is why I wanted to cover the idea of the confirmation bias, because I think too often we go out there seeking information that supports our view, and we filter in the information that's going to support a view, and we discount that, which denies our view. And so we think we've got a balanced opinion of the market, but in fact, we haven't, and we don't recognize that. And the question then becomes, if George Soros is already short, the reasons why he's saying the stock market is, or is out of top, is that talking his own book, or has he got evidence to support that? There's a famous quote, Bernard Baruch, who featured quite strongly. Actually, I know Jamie. I think Jamie Sotelli quoted him in his book on sentiment, but also Jesse Livermore.
Yeah.
There's an association there, but there's a great quote where he said he made his money by selling too soon.
Never heard that before.
Sorry?
I never. Can you tell me who Bernard Baruch is? I don't know him.
Well, I don't want to talk much about him because I don't. I'll be honest, I don't know enough about him, but I know I've seen him mentioned a few times. I'm pretty sure it is Jesse who has talked. Jesse Livermore has talked about it, but let me just find out.
Yeah, in the 1870s to 1965.
Yeah, he's cited by lots of people. He's
Yeah.
it's almost apocryphal is obviously my word of the day, but he's cited by a lot of people as being, it's coming out with pearls of wisdom. I don't know. You can tell I know hardly anything about him. I keep coming across him as someone else saying, you look for evidence of what he might have said, and I don't know. It's a simple answer, but I do know from my own experience that I've sold too often, too many times, and it's why that maxim or that observation is one that's affected deeply my trading strategy. And in fact, someone we had on Friday, Chris Beyer, Brazil 61 on Twitter, Chris and I have spoken many times, and one thing he's asked me to look at some of the things he does, and I know he wouldn't mind me saying this because he's tweeted as much, is one tip I gave him is he sells markets, tends to sell them in threes, or multiples, but drop the first one and see how you get on. And too often we do sell. It's amazing how you can time a top and how often you do well by just leaving it later and later. But if you take the maxim selling too short, selling too soon, and say is George Soros doing the same thing? Is he using confirmation bias? Is he trying to now by selling more, or is he just backing a losing trade? Someone like Jesse Livermore and Paul Tudor Jones quoting Jesse Livermore, and many other people have used the maxim about not averaging losers. If you know you're going to average into a trade, it's often a sound thing to do to know what levels you're going to average in, and it doesn't matter so much because effectively you're not entering the entire trade and averaging a loser. You're actually just building the first or the trade. Whereas someone like George may or may not be guilty of adding to a losing trade. And therefore he may or may not be guilty of looking for evidence of confirmation bias. People who are selling the stock market, people know I've referred to selling the stock market, but all I'm doing is hedging along. I'm pretty hedged at the moment.
But if we look at what happened, I mean, from this time when George Soros had this position, because it kind of ties into something we talked a little bit about before the show, which is an interesting chart for the S&P and gold. So if you just look at the chart here of S&P and gold, this is from last year to date. Yeah. And S&P is clearly beating gold, crushing gold with the orange line. But then once you see year to date, it's inverse. So from the moment that George Soros supposedly had this big short, that's in the money if he kept it. And coming into the year, we saw people almost universally recommending stocks because that's the best business model. There's a lot of brokers. There's a bunch of reasons why anyone would recommend it.
Is price. And when they were writing the articles, the stock markets were at their highs. They wanted to get their article ready for New Year's Day or the first few trading days of the year. And where was the market was at the highs. So I'm sorry, but too much analysis is done to sell newspaper stories. One of the biases there is what is going to sell most.
Yeah.
So what you don't want to make yourself stupid or necessary. So they come out and say, it's going high, and next thing you know is a week later, the world is talking the world down. Um,
Yeah.
and it's it's whatever sells, I guess, which is always a problem.
But
It's
isn't that
always
kind of a confirmation bias when you sit at the end of the year and you see, oh, it's 35, it's a 35% year. I mean, it's one of the best, the biggest years in history. It's just inertia. I mean, confirmation bias can also be like inertia. Like it's here, just continue buying, continue recommending, continue being long, and don't rock the boat. But when you see such a uniformly positive opinion on stocks, isn't that a cause for concern?
yes, and it's listening to coin a phrase, listening to the tape. Don't necessarily. I think I may confuse people. I know I do confuse people sometimes because I will, tweet something or talk about something I know is directly the opposite, diametrically opposed to my view. It's telling me something's wrong, and it may confuse it, but it's what I'm saying. A good example is what the start of the year that people know by now that my view on the stock market is not, if you like, want to pick a date, is now April late. It's April 1928, and so we've got the big blow off to come that we haven't really started at. But beginning of the year, there was very clear signs. It wasn't the time to be overly excited. There were clear signs that the market needed to retrace. I published a couple of fractals that were pretty bearish. In fact, one or two of them are pretty well actually, but they were kind of contradicting my own story. One was the 2000 dot-com bubble analogy that was pretty clear, but you need to just do that sometimes to just ask the question, ask the opposite question in order to get the right answer. Well, actually, of course, we're talking about confirmation bias. Can you put up? I've lifted a quotation, a definition of what confirmation bias is before.
Yeah.
So people understand.
Might be. Ed, I'm having. You're breaking up a little bit. It's your bandwidth, I think. Do you have any bandwidth hogs right now?
Have this? Yeah. Part of the problem is the number of trading programs I have open. I think some of them are.
Yeah, but it's fine.
No.
I'm just saying, like, if there's anything you can, but I can read up the definition, or at least part of the definition from confirmation bias.
Yeah, do that, please.
So,
I'll do it. It's all right. A psychological phenomenon confirmation is a psychological phenomenon that explains why people tend to seek out information that confirms their existing positions and overlook or ignore information that refutes their belief. Occurs when people filter out potentially useful information and opinions that don't coincide with their own preconceived ideas, and affects perceptions and decisions in all aspects of our life and can cause us to make less than optimal choices, allegedly. Seeking out people's publications with different opinions than our own can help us overcome confirmation bias and make better informed decisions. I'm a great believer in seeking lots of advice and keeping my own counsel. And asking myself why are they asking why are they producing this, what is their agenda, why are they saying this?
Yeah.
I mean, there's also a great quote from John Galbraith, Galbraith the economist, up. And there's been some talking about theorists like Galbraith. He said, faced with the choice between changing one's mind and proving there is no need to do so, almost everyone gets busy on the proof. In other words, we've got an idea, we know we'll go out there and prove it. But there's been a lot of, because it's in the whole field, it applies to everything in life, this, confirmation biases and how that affects decision making, not just in trading. There's been a lot of work and a lot of papers on it, but there's a really interesting paper that was done on the turn about 10, 15 years ago by Jones and Sugden. I think I've actually got a pin for it there if you want to, it's towards the end.
This one?
Yeah, but what it was saying is there's not only do we look for information to support a view,
yeah,
we actually go and we take any story of dubious information, doubt, value to support a view, and then start filtering it out.
Yeah.
the good stories. But what they're actually saying is, because of that, because we've skewed the whole pitch in how we look at markets, look at things, there's a
So we're having a little bit of problem with Ed's connection here. I'm gonna try to dial him back up. I think he's got some broadband issues here. Ed, are you back with us now?
you tell me.
Yeah, you're breaking up here. Let me dial you right back here. I'm sorry, since this is live, I guess we're having some issues. Let me just disconnect you and dial you back.
Sure.
So we're just having a Skype issue here. It's likely just a localized problem. So it's going to be a few seconds, and it's going to be back. I know Ed has had some issues with his bandwidth before. Is that better now?
Yeah.
Yeah, good.
Well, I don't know. You tell me.
Yeah, it's at least it's fluent. We can take away video if it doesn't work more. That would reduce the strain on it. But it's good now.
Yeah, it's getting obviously it's getting in the way of your end. It's getting a little bit in the way of my end, but I don't know where it's going. So apologies for that.
Yeah.
The point, just to wrap up what I was talking about, some of the research says not only that people do naturally have a confirmation bias that clearly gets in the way of trading when you're trying to do analysis in a neutral way to to come up with some sensible trading strategies. That you start filtering information that supports your preconceived idea, but then you bring in really spurious stuff like saying if you're short, George Soros has sold that and he's selling more, therefore I won't stop out of my short yet. I'll run it based on what? Because someone's reported a story that is about 3 weeks old or whatever.
Yeah.
And then you start to and then you start filtering out some really good stories that may be of benefit. For example, Janet Yellen, there may be some research showing that what's going to happen with taper and why the market's going nowhere fast in a hurry. You're not going to listen to that. You're listening to the story that says you should be short. And one of the things, a lot of work done on this area. One of the studies shows there is a disproportionately high benefit from filtering in the negative stories, the stories that don't fit into your view. Once you start filtering those in, you can actually do it very methodically and saying, is this true?
Yeah.
Is this, what weight should I give to this view? And that by doing that, you actually end up with because you've got a bias starting point, you neutralize the bias starting point, and you can end up making a far more sensible decision. And it's something I try to do quite a lot, is I do take in a lot of these stories that affect my view. Partly also some of the things I look at, not just fractals, but Elliott wave throws up all sorts of alternatives that can be justified. So, I look at the alternatives and then try to attach a probability and then, use the evidence to support or deny that so I can come up with the most probable story.
I would say that that's almost the definition of an intelligent investor or trader. Being able to ask yourself the hardest possible question with, am I phenomenally wrong in this? And am I willing to entertain completely new information for it? And I see it so many times that people just flat out refuse things that either they don't understand or don't appreciate. So, and then the smartest guys always entertain anything, really. I mean, as long as it's information, it's worth looking at.
There's quite a useful thing. Again, trading encapsulates many things in life. There's actually a good video, which I don't know if you can share or not, but it talks about recognizing bias. Have you got that? I think it's on the list.
The How Stuff Works on?
Yeah. Can you show that? And look at it. Let's look at it from a trading perspective, because this talks generally about science, I think, more than proof. But it's kind of interesting. You think of it from a trading perspective.
Did you have an intro for it? I'm sorry, it started. Did you want me to have the audio or?
No, just let it run.
Okay.
Yeah, it's fine.
So this is from How Stuff Works website.
Now that you know a bit about the Kennewick Man controversy, what criteria would you use to recognize bias in articles about him on the Internet? When studying controversial issues, It's important to realize that an article may omit or skew important information. Be aware of propaganda or faulty reasoning. You should determine whether the writer's opinions are evident in the article and whether the author has taken sides. That said, some articles will include multiple sides to the story. Equal time should be devoted to each side of the story to prevent it from seeming one-sided. For example, an article focusing more on the scientist's reasons for wanting to study Kennewick men might create a bias that could cause you to take the scientist's side. Also be wary of the editorializing of quotations. People interviewed should be accurately quoted. Are their quotes used fairly, or is bias being infused by purposely using quotes to paint a negative picture of one of the opposing sides?
I just want to comment a little bit on this because having been a writer professionally, I saw this all the time where people would attribute quotations almost like just as it saw them fit, and would put quotation marks around things they thought should be the quotation but wasn't actually the quotation. So it's just an interesting point. It's very rarely that quotations are used fairly and accurately, I would say.
Yeah, but it's also, sorry, I've probably run enough. One of the, I mean, this is, I would look it up how stuff, was it called How Stuff Works? It's kind of interesting if you look at it from a trading perspective, because we, you know, talking about the quotes, I see this all the time. I will say something on Twitter, and I will say, you know, put out a chart, and then someone comes back. You know, to me the chart was quite clearly bullish, and what I've done is, you know, suggested it's going higher because of X, Y, and Z. Someone's picked it up and talked to me as if I'm bearish.
Yeah.
And what they've done is they've taken the little bit of information from what they see and turn it to their agenda. Now the problem, that's bad enough, but the problem is when someone else does that. You know, I keep citing the Wall Street Journal because I'm reacting to that George Soros in 1929 story. When someone else does that, they then, because they seem to be neutral, they then give the impression it's fact. And that's the danger. Is with a lot of people like that, is they start giving the clear, not that it's an opinion, but they've taken something, they've skewed it, and they put the question marks. You know, your point, I'm not saying the Wall Street Journal's done this, but quite often this happens, or even how one presents the story or whatever, they present it with an apparent agenda. You ask yourself why.
But I mean, your former career, I'm sure you were interviewed a lot. And you were quoted all sorts of places, I would bet.
Yeah, yeah.
Do you feel like it's a comfortable situation to be quoted? Or do they misquote you?
It's quoted as long as the agenda is as long as there's no agenda. I will go so far as say that. Yeah, some people will know me. If you Google me, you'll see my one of many reasons why I stepped out of politics was to do with a story that was run that was just complete fabrication. You know, it was during an election, and I was interviewed. I'm happy to talk about this. Interviewed by a paid-up member of the Labour Party in the Times, hit front page of the Times, and the guy was just out to bury me and misquoted me, etc., etc. So yeah, they've got an agenda quite clearly. They were paid-up members of the Labour Party trying to do the Tory Party in an election process that I was involved in, and I was unfortunately the fall guy. And
it's got to be horrible.
That happens, you know. That's the nature of politics, but it's also the nature of journalism, and it's also the nature of markets. And the difficulty for a trader is to see through all those agendas. So the way to do it is to ask yourself, why is this person telling me to do something? Why is a broker telling me to get really excited and involved on a day that's going to do nothing? Is it because there's a genuine opportunity, or is it because they just want my business? And I don't mean an nasty of any broker, because most of the brokers you see me talking to, I've got a lot of time for. And that's one reason why I talk to or follow them, because they're out there trying to help people.
Yeah.
You know, and so you can't attribute. I can't then now turn around and say everything the Times ever does is wrong and is fabricated and created. And I can't say that of Rupert Murdoch. Can't say that of the Wall Street Journal. There are some instances when one gets suspicious of that, and if you get suspicious, the thing to do is to discount it. Yeah. You know, you just forget exists. So from my point of view, if I really, to me, George Soros selling a market because he thinks it's overvalued, given his history, he picked he fought gold. He was a bit early on that, but he basically got it right. If he starts fighting, I pay attention. But when I don't believe the story or I'm not sure of the story, what do I do? Do I start basing my decisions on what could be, or I base my decisions on what I know to be, or believe very strongly to be? Because you don't always know. You can't always know everything for sure, and so I discount it. So the George Soros story to me is not a story.
Yeah.
For those reasons, it might be a story, but for my decision-making process, it's not. Partly because I'm also that way, and this is a problem as well. I've now, I'm hedged in the stock market, and now I could use that story to back my trading strategy for today, and then deny the story next week because it's it's so inclined. So George Soros has said many things. One thing he has said that's really interesting is his whole I was going to say reflexivity concept about how. And there is a great quote. I've quoted it before. Can you spot that quote he talked about? It's quite a long one. When he's talking about perceptions and fact to perceptions.
I think it's this one.
Yeah. Well, again, someone else is interesting. Again, someone else, a very clever guy, who has made some serious money, now is looking, or has, not now, but has for many years looked to do other things, but a deep interest in finding the truth and exploring ideas like that. And he's come out with a few theories himself. One is the reflexivity.
Yeah.
When events have, I quote, when events have thinking participants, the subject matter is no longer confined to the facts, but also includes the participants' perceptions. So we're talking, when it comes to confirmation bias, we're talking about not just the trader's perception of how he interprets something, but how the story is relayed as well by the media. The chain of causation does not, and I quote again, the chain of causation does not lead, this is from causation from fact to market movement. You can bring that back up?
Yeah.
The chain of causation doesn't lead directly from fact to fact, but from fact to perception and from perception to fact. And in fact, you can see quite clearly from our conversation that it's actually more complex than that. So you need to get down into the truth and also understand also how people will be affected by something like George Soros standing up and saying that. And it's interesting. If you there's actually, I would recommend people read. There's a couple of good videos out there. Have you got a George Soros video?
Yeah,
talking about reflexivity.
Well, I have his lecture here, and I have a few. So
yeah, well,
there's a nice Vimeo video. It's about a 2-minute overview of George Soros and the theory of reflexivity.
Well, yeah, run that.
I think that's a really good one.
I would recommend people look. He did a great paper in 2008 called "The New Paradigm." There's some interesting papers he's produced. Can we run that video you were talking about?
George Soros and the theory of reflexivity, also known as self-fulfilling prophecies or the bandwagon effect. Since the dawn of existence, we have tried to explain our surroundings. Unavoidably, we also react to them. But most of the time, our reactions don't have an impact. This is where financial markets differ. Our reactions actually do have an impact, change the environment, and create a feedback loop of further reactions. This is the theory of reflexivity. It looks like a normal nice day, but Jim, a big investor, decides to start selling because he feels bearish. Maybe he came across a black cat on the way to work. Who knows? Bill and Sarah take notice. When they don't know what's going on, they don't stick around to find out who's the patsy. So they start selling too. More investors notice and more selling follows. The result? Prices keep falling. Consumers lose wealth and confidence. Businesses stop hiring. Demand evaporates. And suddenly, the whole economy is in shambles. Selling in fear of a weak economy impacted the environment and became a self-fulfilling prophecy. This is why financial markets are prone to booms and busts that don't have to start with a crisis, but can cause one.
Yeah, we should have started that. That sums it up really well.
It's lovely.
Well, as an example, and maybe you can argue that he actually thinks the market's going to go through another spiral like that. And I'm saying the evidence isn't clear. I haven't seen the evidence that he thinks that at the moment. But what is interesting is he's within that theory. He's talking. What he's saying is he's challenging traditional theory, market efficient market theory, that the market's always looking for, always finding an equilibrium point because everyone knows everything. He's actually saying the reason why the markets hit bubbles and get massively overvalued or undervalued is because of that reflexivity. When people see people selling, they sell more. The market then jumps a level of volatility. And what is interesting, I think, for me, just a small private joke, is that I actually think he's not applied his own theory to the market if he's selling now, because I don't think the market has gone that extra level, hasn't reflexed, if you like. In other words, the market may be overvalued now, but it's not the case that lots and lots of people, we haven't wiped out the bears and got the bears and the 1929ers now, as I think we should call them, have not started buying and stopping out to the upside, and things haven't got really stupid to the upside that we've seen so typically at the bottom and in previous crashes, if you like.
I think you're right. The fact that people are calling for a crash means that it's probably less likely, because that's part of the pricing, isn't it?
Yeah, absolutely. And and you seek, and what is interesting is he talks very interestingly about a number of concepts, brings in a few other concepts like Heisenberg's principle of uncertainty. That it's difficult to measure something when you're measuring it, you're actually affecting it yourself.
Exactly.
They apply it to in the science, measuring an atom. When you go to measure the atom, you can't measure it because you're actually measuring it, type of thing. And that's the problem. What we create in a situation like now, I think interestingly in the market, is because I've never seen a top where so many people talk about a top. And if it turns out to be a top, it'll go down in my history, my mental history, as being the only top I've ever seen where everyone is talking about it being a top, which is evidence to suggest that it may have been a top, it may be overvalued, but because everyone is now talking about it being a top, it now can no longer be a top. It needs to do something to start again.
Exactly.
And that's why it's his point is that markets aren't such a clear chain of causation, that things can get in the way and perceptions get in the way. And in this case, he's actually joined the chain himself, or it's not necessarily his fault. And that's why it's so important to look at things in a neutral way, and try and step out and be really cold about some of the stories and say, yes, do I count this in? Do I count this out? I'm going to stick to my charts. This is why so many people do, and probably very right to stick just to charts, because they can get rid of that all that rubbish. There's a great quote from Jesse Livermore that's down on the list. Do you want to put that one up? An interesting picture of Jesse Livermore I've never seen
I've never
before.
seen that before. I noticed that before the show.
Yeah, do you want to read it out for me?
Bring it up here 1 second. There we go. These words, bullish, bearish, are not in my vocabulary because I believe they can create an emotional mindset of a specific market direction in a speculator's mind.
Yeah, you see, to me, that doesn't sound like 1920s. That sounds like someone who just, could be doing this show now, or probably doing a damn sight better version of it, not just the technological issues. But it sounds really current. I mean, I tweeted that. There's a story about, the bull, we shouldn't be calling it bull and bear, and I showed this lovely, cute picture of a panda, a real panda riding a toy donkey, was it, or something like that? Because we emotionalize, and we talked about this, people talking about trench warfare, it raises the ante. We should have thought bull and bear side. Don't get trapped into thinking the market's going up forever. Markets move in two ways. There's opportunities to make money buying and selling. Don't ever, get yourself into emotional time frame perspective, I believe, that you're always selling, because you'll miss. if even if you're really good and you pick the tops and you get the retracements, even if you're really that good and you're successful at doing that, you'll miss half the market, and you'll miss more than half the market if it's in an uptrend. Yeah, so it's best if you can to get more of a balanced approach. And there are a number of ways you can do that. There's you put up the other Burner Baruch quotation.
Down. Is that the right one?
Yeah, that's perfect. Consider and reconsider the facts and your opinion. Stubbornness as opinions and cockiness must be entirely eliminated. Just keep, we talked about a continuum, a narrative. Just keep asking yourself, is this right? And I every day, several times a day, I ask myself, am I being stupid? I'm one of the big, I would argue, I call myself like a pioneer on fractals, and there's people using this fractal, the 1929 fractal, to call a crash, and I'm long. Am I being stupid? I mean, I keep looking at the evidence, keep looking, trying to convince myself that I am being stupid and that in fact I should be selling. And the net result is I'm sticking to my original plan. I'm not going gun-ho about the bull side. I'm just phasing out my longs here, which is probably a good... I think there's I could talk forever and go into all the ways of removing confirmation bias and all the biases out there. But the important thing is to stick to whatever you do, stick to that form of analysis, stick to your trading plans.
Yeah.
Filter in information and out. Don't seek information to support your view and deny it. Just bring it into the pot and go, no, I don't believe that. No, I don't believe this. This is not right, etc. And then look at how that is changing the perspective. Yeah. And then, as I said, the easiest thing to do is if you rely on charts and you don't rely less on even reading sentiment, then it becomes much easier to do that. And something I would argue, something like fractals is the easiest thing of all, because it's like an objective map. You don't need, it's a map. You can't really lie. You can apply it wrongly, I suppose, and many people do apply fractals to support their view on, they have a clear confirmation bias. Perhaps if you put up the S&P correction.
Oh yeah, I wanted to compliment you. I was starting a tweet to talk about this, because this is truly remarkable how much you're able to correctly predict. Because we've been talking about this quite a few times, and it's very accurate.
I've tweeted something like that for the last 18 months about the different corrections. And it comes from, and it's the starting point. Let's try and bring that back to confirmation bias. I've told many before, I have a natural bias to sell indices because I am naturally long stocks. So I'm always looking to hedge. But for the last year, I've been pretty long and pretty bullish. I've been short quite a few times. But one thing I try and do is because I do use fractals, I'll go back and say to myself, if this is a top, what do tops look like? And I've showed, one fractal I was able to pick was the comparison, strangely, of the Dow in 2000 with the S&P now. Highlighted the S&P was had a dump in it. And also, but using the other evidence to say that, okay, this dump would be a correction. If it's a correction, may not be, maybe a massive trend reversal. What's happened previously in history? And that's the previous corrections we've seen. And you follow that, and then it's highlighted basically a bottom and a buying opportunity, and now highlights there's not one rally there really, apart from the major rally that we're in still, actually. You can argue that has it gone to sustain the move to new highs, two new highs without some sort of major retracement. And that's what I'm banking on now, is that there'll be a major retracement in the market. And also if you take the DAX Mandelbrot, for me is the clearest market of all, has helped me, not just from the point of view of providing, put the DAX chart up as well, providing a clear risk return, a brilliant risk return long, but it's provided an excellent map that has taken a lot of heat, a lot of the emotion, the confusion, the confirmation bias, seeking evidence of one thing or the other, just following the saying, well, basically I'm staying long this baby because it's saying it's going higher. That's the tool I'm using. I'm not going to listen to stories surrounding the fat finger on the DAX as it breaks to new lows, that someone's selling a wedge. all sorts of stories out at the time. It proves to be, just fat fingers or whatever. Ignoring any of that, what it looks like spurious information that could confirm or deny, letting the price action confirm and deny. And that's what I've done. And it's been a remarkably successful trade by not doing anything, quite frankly, or doing very little. Again, now I've hedged, completely hedged. If you look at the fractal, what it's saying was we were going to follow, we're going to rally. We're not going to break to new highs yet, but it actually said not only is the structure the same, but if it follows the same in price, exactly in price, the level, the high it would find before it settles back down into week's consolidation is, and what's the high of the day? Do you know what the high of the day is on the DAX?
On the DAX, 1 second. You sprang that on me.
Of course, that's what I'm here to do, is to challenge you.
The high of the day. We're at the high of the day now. Right now. It's about high is 9649, I think.
No, let's see. There was a pre-high tagged. I got filled at 96.90, sorry. That's not, but that was a pre-market fill. I often do that because opportunities pre-market. The highest
DAX
price
futures
you
or
could have
DAX?
traded the DAX in the last 24 hours is 96.90. Now, you can't have got that. You won't have got that in the cash market or after the market actually opened. But the point is, this fractal is saying 96.90 would be the high if it matches it price, exact price.
Yeah.
And so far, it's matched it exactly. 96.90 is now saying we're going sideways to down for a week, as much as a 300 point decline, which is obviously going to be pretty spectacular if we can get it. But again, I look for signs and information that's going to support that view. And one obviously is the price coming off.
Yeah.
Another will be the what people are talking about, the market evidence that the market is now getting bullish and long, and seeing there's any real indication that any of the other markets, the surrogates, euro yen, I've been looking for crosses there, looking to see some signs of a retracement back down. And the problem is, I think from the bear's point of view now, and what I find interesting is that there's so many people been calling a top in the stock market who are wrong at the moment, but now, when people are finally giving up the ghost, now might be the time to sell. I mean, do you want to put out for me what is probably a good place to end? A George Soros quote himself about crying wolf.
Yes.
Because if you cry wolf too many times, then people won't listen to you. Wall Street Journal covered a story about 1929, the market ramped. It then covered another story about 1929, it went even higher. Now, the market's even higher, the story about it being a crash, and people say, it's rubbish.
Yeah.
Don't believe it, And so, do you want to read that out for me?
I have a record of crying wolf. I did it first in The Alchemy of Finance in 87, then in the Crisis of Global Capitalism in 98, and now in this book. I'm not quite sure what it's referring to. So it's 3 books predicting disaster. After the boy cried wolf 3 times, the wolf really came.
Yeah, basically what he's saying, he's picked the top, and in every book he's written, he's called a market a bubble. So, you could argue that coming out now, or the Wall Street Journal coming out on his behalf, was the top? I don't think so. If he came out now and said, I'm selling, if he wrote it in a book and gave us strong reasons why he thinks the market is now at the top, then there would be another instance when he might potentially call a top. What for me it's saying is there's been a lot of evidence that this market is going nowhere fast, and that today may actually be the Wall Street Journal may get it right in the sense that today may be an opportunity to sell. That is supported by the 2 fractals I'm looking at, the S&Ps and the DAX, but it's also supported by a lot of the noises we're hearing. But you don't need the likes of me to say that. You just use your chart, use your methods, and stick with it. And if you're getting a lot of rubbish, people saying a lot of rubbish, then just filter it out and try and stick to what you do best. If what you do best actually makes you money.
What do you use to Do you have a favorite tool to check yourself?
Yeah, something I would not recommend people do. I would uh, I actually tell people not to do this, but I do it myself. I look at my P&L.
Yeah. If it's going too
Uh,
well.
I saying this is what I think. This is what I'm doing. This is what I'm using. Is it working? Look at my P&L. Look at my DAX.
Yeah.
Look at my DAX, man. But look at it's up 4-5%. Thank you very much. Caught the move down, caught the move up, caught the move down, caught the move back up. Based on a fractal, what do I use? I use things that work.
Yeah.
And if I found using having an agenda and using a massive amount of bias, confirmation bias work, then I would stick to using it. There are people out there, I'm not going to mention any names, who quite clearly have a bias into selling or to buying. However you make your money, your first big trade tends to be a bias that you keep forever. I think I must have made money selling because I'm a natural greater seller, but I've experience and my profit has come from buying, so hopefully I've neutralized it. But there's nothing wrong in having action bias, as long as you recognize, the name of that video, recognizing bias. Once you do that, you can apply. It's much harder, but you can apply the old approach recommended by Bernard Burke, going back over and over what you do, saying, well, I'm a natural seller. I'm going to be bearish, but I'm
Yeah.
going to factor that in. So in fact, you can say that as a natural seller, someone is always bearish, when you're least bearish might be the opportunity to buy. When the market, you might be bullish, like for the market, looking for that blur, but when the market starts to go bullish on me, and the people, being talking 1929 bearish start getting bullish as well. Maybe that's time to step out for me to sell.
Yeah.
And that's how you factor it in. You understand what you're using and the noises you're hearing, and then try to apply that.
Yeah.
And there've been a lot of markets where it's quite clear people have lots of different agendas and talking a lot. One of the interesting markets is gold. I mean, we started off talking about the divergence between gold and the S&P, the chart you showed.
Yeah.
A lot of people have an agenda to talk gold down. There's also a lot of people with a natural bias because it's been a major bull market to buy it up. And it's one reason why it's actually going nowhere and been going nowhere. It's going up at the moment within the nowhere, big range. I mean, 1180, 1380, pretty much. It's the range it looks like, and it's got scope to go higher. But in the scheme of things, I think the sentiment and the noises and the biases are going to keep it trapped.
Yeah. It's almost like it's guarding the up and downside. You have the gold bugs and the haters on each side just guarding it.
Yeah, and I personally don't think I'm not trading gold very much at all. I occasionally dip, drop in and out when I think it appears to be trending. I'm tempted now in this short term to see a sell-off and buy into it for pushing 1380. But then I'll be, of the mind that it's top of the range and be more inclined to sell it. There's nothing in gold there that really excites me yet. I am looking for it to get exciting later in the year.
Yeah.
It's interesting, some of the studies that are out there currently in gold and talking about, the investment, the hedge funds and everyone else is out of it, and now they're selling, are they? Yeah, right. Stories to see people's books. A lot of stories out there that, that they're trying to have a particular agenda. Sorry, perhaps would end there, but there's a great piece of work actually that I haven't referred to much, book on technical analysis. For technical analysts, in fact, although it tends to go wider, by Kirkpatrick and Dahlquist. And they talk a lot about sentiment, and quite in a savvy way, about sentiment and biases and emotions. And they say that, this is a great quote, remember that they, traders, technical analysts, are subject to the same human biases as other people. This set of human biases is so strong that even those who recognize them are still affected by them, and must constantly fight against them. So know your biases, but factor that in. Successful traders and investors often say that the worst enemy in investment is oneself. Yeah, I mean,
Yeah.
don't be your worst enemy, be your best friend. Do what you do best, stick to it.
Yeah. I think that's a good place to end it. And if you're just tuning in for the first time, I would love it if you go to our YouTube account. You'll find it under here somewhere in the video. And you can follow our podcast on iTunes. We have an audio version of all our shows. And I would love if you could stick around because we're going to do another show now, which is the third installment of something called Structured Research. And we're going to be talking about exactly this, making the case for gold, the most hated investment possibly in the world. We have some really cool indices that I've never seen before. And we're going to be joined by Michelle, which you know, Ed, right?
Yeah, no, Michelle's excellent. I'm I didn't know she was going to be coming on and talking about gold. I'm sorry I mentioned opinion because I don't want to skew any pitch. But I think I kind of set up the pitch for it to go anyway, quite frankly.
Exactly.
No, but Michelle, I would definitely listen. Michelle's a very bright girl,
Yeah.
lady. I should cook. Yeah, I'd certainly. There's a lot of interesting things, and it's interesting. I'm going to listen now because again, going back to the point about confirmation bias, I have a bias that's going nowhere fast. If someone wants to make a good case for it going one direction or the other, then I'm all in.
Yeah. It's not that we're making the case. We're the story behind structured research is taking all the banking research and making sense of it, and taking the stuff that you normally never see, and then looking at that. But first, before we go into gold, we're going to talk about another hugely biased story, which is Norwegian housing, which is, you can say British housing is fairly a similar market, which is, well, what do you think about the housing market?
What's the phrase? Not an Englishman's home is the castle, but a Norwegian fjord is his bath. Is that? Yeah, I don't know.
Is that a phrase?
I just made that. No, it's just yeah. It used to be the case that the Brits were very into property and elsewhere, and they all ever did was talk about weather and house prices. But I think for many years, when any market gets into a boom, that's what people talk about.
Yeah.
Going to New York, they talk a lot about house prices. What I think about house prices is a reflection of. It's an interesting market. It's a reflection of income and people's confidence in their income, which I did some work on that when I started buying into property aggressively decades ago.
Yeah.
That I found the correlation was house prices went up with interest rates, which is counterintuitive, and that when the reason simply was because as inflation started coming in, as a sign the economy was doing well, interest rates would therefore start going up, and the property prices were going up because the economy was doing well. People's incomes were growing, but more importantly, they felt comfortable about their incomes going up further. So the extent to which house prices will go up really does come down to people's confidence, and people in the UK are becoming more and more confident as to what the economy is doing. The headlines of growth, people feel a little bit more secure about their jobs.
Yeah.
There are fewer people unemployed, so more people to be confident about their future, hopefully. So I would say even though the property market seems people talking about bubbles again, based on that analysis, the property market's got further go on the upside.
Yeah. Well,
anyway,
it's
I've
definitely
just
stopped
talked to
here.
two subjects now that Michelle's going to talk about.
Yeah. Well,
and
we're probably gonna be a subtle mix. We have a really good Goldman note on housing, so I think that's a good starting point. And I'm glad you say you're gonna watch because I'm gonna enjoy doing the talk. So I think we're gonna go straight into it. And starting tomorrow, we can be on all three at the same time, but we have to just do one little change that I didn't have time to. So we have to do a hard switch here. I'm sorry about that. But I want to thank you, Ed. It was an excellent conversational
An excellent
piece.
ramble on George Soros and confirmation bias. Both can be your best friend.
Yeah.
Just
Well,
know how to
George
use
Soros can be your best friend. I would like that. Seems like a
Well,
interesting
George
guy.
Soros can be your best friend. Yeah,
Well, it can,
definitely.
I guess.
Anyway, mate, have a good one.
Have a good one.
Good luck, everyone.
Thanks so
Yeah.
much. See you
Cheers.
tomorrow.